Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today, I want to spend some time talking about something that doesn't get nearly enough honest attention in the retail investing world, and that's the macro investing mistake so many everyday investors make, often without realizing it until real damage has already been done. Macro investing has this reputation of being intelligent, strategic, almost elite. People hear about inflation, interest rates, central banks, and global events, and they feel like if they understand those things, they'll automatically make better investment decisions. And while that mindset isn't wrong, it's incomplete. Macro investing can absolutely improve your results, but only if you understand how easy it is to get it wrong. The reality is that macro investing mistakes tend to be subtle. They don't always show up as instant losses. Instead, they quietly drag on performance over time, creating frustration, confusion, and a sense that markets are somehow unfair or unpredictable. In most cases, though, it's not the market. It's the approach. One of the first mistakes I see retail investors make is ignoring economic cycles altogether. Markets move in phases. Economies expand, slow down, sometimes contract, and eventually recover. Each of those phases creates very different conditions for assets. But many retail investors don't think in cycles. They think in recent history. If stocks have been going up for years, they assume stocks always go up. If interest rates have been low for a long time, they assume low rates are the natural state of the world. That kind of thinking works until it doesn't. And when the environment shifts, portfolios built for the previous cycle can struggle badly. The mistake here isn't failing to predict the exact turning point. That's nearly impossible. The mistake is failing to recognize when conditions are changing and continuing to behave as if nothing has shifted. Closely related to that is another common macro investing mistake, which is overreacting to headlines and short-term data. Every inflation print, every jobs report, every central bank comment gets turned into a dramatic event. Markets spike, markets drop, and social media explodes with opinions. Retail investors feel pressure to act immediately, as if every data point requires a trade. But macro trends don't work that way. Economies don't pivot on a single report. One number rarely changes the big picture. When investors trade every headline, they end up churning their portfolios, entering late, exiting early, and letting emotion drive decisions instead of strategy. This creates the illusion of being active and informed while quietly harming long-term results. This is where structure and discipline become incredibly important. Having a professional environment to analyze markets can help you step back from the noise. That's why I often mention the platform at crystalballmarkets.com/platform. It's a world-class, cutting-edge, user-friendly trading platform app that helps traders focus on data, structure, and risk instead of reacting emotionally. If you're serious about improving how you trade macro ideas, it's worth taking a look at crystalballmarkets.com/platform and seeing how a more professional setup changes your decision-making process. Another major macro investing mistake is confusing opinions with facts. There are endless confident voices in financial markets. Some are thoughtful, some are reckless. Many sound convincing because they speak with certainty, not because they are grounded in reality. Retail investors often adopt these views without understanding the assumptions behind them. True macro analysis is about probabilities, not predictions. It's about understanding what could happen, not declaring what must happen. If you can't explain why you hold a view, what evidence supports it, and what would make you change your mind, then you don't really have a macro strategy. You're borrowing someone else's conviction. This is why deeper education matters so much. Quick clips and headlines rarely explain reasoning. Long-form conversations do. If you want to build real understanding of trading, investing, macro, and financial markets in a way that's actually beginner-friendly, I strongly recommend checking out the Crystal Ball Markets podcast series. You can find it at rss.com/podcast/crystalballmarkets. Again, that's rss.com/podcast/crystalballmarkets. It's a great resource for learning how experienced traders think through macro problems instead of just hearing conclusions. Now let's talk about overconfidence in forecasting, because this is one of the most damaging macro investing mistakes retail investors make. Many people approach macro investing as if the goal is to predict the future with precision. They try to call the exact peak in inflation, the exact path of interest rates, or the exact timing of a recession. The problem is that macro systems are incredibly complex. Even professional economists, with access to massive datasets and institutional resources, revise their forecasts constantly. When retail investors treat forecasts as certainties, they tend to build portfolios that only work if they are perfectly right. That leaves no margin for error. A better approach is to think in scenarios. Ask yourself what happens if you early, what happens if you wrong, and what happens if conditions evolve differently than expected. Structure your positions so that being slightly wrong doesn't destroy your capital. This shift alone can dramatically reduce macro investing mistakes. Risk management ties directly into this, and unfortunately, poor risk management is one of the most expensive errors retail investors make. Macro trades often take time to play out. Prices can move against you long before your thesis is validated. Without proper position sizing and exit planning, even a correct macro idea can result in losses. Many retail investors take oversized positions because they feel confident in their view. Others use too much leverage or concentrate too heavily in one theme. These decisions turn normal volatility into catastrophic outcomes. Risk management isn't about limiting upside. It's about surviving long enough to let your edge work. This is another area where using the right tools makes a real difference. Platforms like crystalballmarkets.com/platform are designed to help traders understand exposure, volatility, and risk across markets. If you want to manage trades with discipline instead of gut instinct, that platform is a strong place to start. Another macro investing mistake that shows up constantly is failing to diversify across asset classes. Many retail investors say they are macro focused, but their portfolios are almost entirely equities. That's not macro investing. That's equity investing with a macro story laid on top. Different assets respond differently to changes in inflation, growth, and policy. Stocks, bonds, commodities, and currencies each have their own behavior patterns. Ignoring those relationships leaves portfolios exposed when conditions shift. True macro investing means understanding how assets interact and building exposure intentionally. This doesn't require trading everything at once. It requires awareness and balance. And again, education is critical here. Podcasts like the ones available at rss.com/podcast/crystalballmarkets do a great job of explaining how macro forces impact different markets in a way that's approachable for retail investors. Another mistake that often goes unnoticed is ignoring global interconnections. Markets are global, even if your portfolio isn't. Interest rate decisions in one country affect currencies worldwide. Supply chain disruptions in one region can drive inflation everywhere. Geopolitical events don't stay contained within borders. Retail investors who focus only on domestic news miss these connections. You don't need to track every international headline, but you do need to understand how major global developments influence markets you're trading. Finally, one of the most underestimated macro investing mistakes is expecting immediate results. Macro investing rewards patience. Themes take time to develop. Yet many retail investors abandon positions too early because nothing happens right away. They assume the idea was wrong when, in reality, it just needed time. This leads to constant strategy hopping and repeated frustration. Successful macro investors align expectations with reality. They size positions so they can stay invested, manage risk carefully, and allow time for their thesis to unfold. Before I wrap up, I want to leave you with this thought. Macro investing isn't about being right all the time. It's about avoiding major mistakes, managing risk, and staying adaptable as conditions change. Retail investors who focus on education, structure, and discipline consistently outperform those chasing certainty and speed. If you want better tools to support that process, explore crystalballmarkets.com/platform and see how a cutting-edge, user-friendly trading platform app can change how you approach the markets. And if you want to deepen your understanding through clear, beginner-friendly conversations about trading, investing, macro, and financial markets. Don't forget to visit rss.com/podcast/crystal ball markets and subscribe to the Crystal Ball Markets podcast series. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for listening, and as always, stay patient, stay curious, and respect the macro.